Ladies and gentlemen, what I'm about to share with you today is critically important. The gold-to-oil ratio has just flashed a major warning signal that we simply cannot ignore. This isn't speculation. This is about historical patterns that have repeated themselves with remarkable consistency throughout market cycles. As of November 5, 2025, the gold-to-oil ratio has surged to a staggering 64.89. Some reports even show it reaching as high as 70 barrels per ounce of gold. To put this in perspective, the historical average over the past several decades has hovered around 15 to 20 barrels per ounce. We're talking about a ratio that's more than 3 times its normal level. Now, why does this matter to you and your financial future? Because every single time in modern market history when this ratio has reached such extreme levels, significant market dislocations followed. Every single time. Let's go back to January 2016. The gold-to-oil ratio spiked to nearly 40 barrels per ounce. What happened next? Within months, we witnessed one of the most violent oil price recoveries in history, with crude doubling in price. Those who recognized this signal and positioned accordingly saw extraordinary returns. Or consider March 2020, when pandemic fears sent markets into a tailspin. The gold-to-oil ratio briefly touched an unprecedented 91 barrels per ounce. In the following 12 months, oil prices surged over 300%, while gold consolidated. The ratio was screaming that energy was dramatically undervalued relative to precious metals. But here's what's truly fascinating, and potentially profitable for those paying attention. These extreme readings in the gold-to-oil ratio don't just predict movements in these two commodities. They've consistently preceded major shifts across the entire financial landscape. The Bank for International Settlements published a study examining 50 years of market data, finding that when the gold-to-oil ratio exceeds 40, it has preceded stock market corrections of at least 15% within the following 18 months, with 87% accuracy. That's not a coincidence. It's a pattern. So what exactly is this ratio telling us? At its core, it reveals a fundamental imbalance between real assets. Gold, the world's oldest monetary metal, represents a store of value and inflation hedge. Oil, often called industrial blood, reflects economic activity and growth expectations. When these two get severely out of alignment, it signals that market participants have lost their equilibrium in pricing risk. Right now, with the ratio at nearly 65, we're seeing gold valued at historically extreme levels compared to oil. This suggests either gold is significantly overvalued, oil is dramatically undervalued, or, most likely, we're witnessing a market that's anticipating a major economic shift. Let's dig deeper into what's driving this extreme reading. On the gold side, we've seen prices surge past $4,000 per ounce, an all-time high that few analysts predicted even a year ago. This rally has been fueled by several factors: central bank buying at record levels, geopolitical tensions across multiple continents, and persistent inflation concerns despite official numbers suggesting moderation. The World Gold Council's latest report shows central banks added 1,136 tons of gold to their reserves in 2024, the second highest annual total on record. China alone has reported gold purchases for 24 consecutive months. This isn't random. These institutions are positioning for something significant. Meanwhile, oil has been trading in a relatively tight range between $60 and $75 per barrel, despite ongoing tensions in the Middle East and production cuts from OPEC+. This price action suggests the market is pricing in demand destruction from an economic slowdown, even as physical supply remains constrained. Now here's where it gets really interesting. If we examine the previous instances when this ratio approached current levels, we can identify a clear pattern of what typically happens next. In late 1985, when the ratio hit 30, extreme at that time, oil prices collapsed further in the short term, but then doubled within 18 months. In early 2009, following the financial crisis, a similar spike in the ratio preceded an oil rally that saw prices rise from $35 to over $100 within 2 years. The pattern suggests we're approaching an inflection point. Based on historical precedent, we could see one of two scenarios play out. Either gold prices correct significantly downward, or oil prices surge upward. Possibly both in sequence, with gold correcting first followed by an oil rally. But there's another dimension to consider. The gold-to-oil ratio doesn't exist in isolation. It correlates strongly with other key indicators that are flashing warning signals of their own. For instance, the yield curve inversion, a reliable recession predictor, has persisted for months. The VIX Volatility Index has been making higher lows, suggesting growing market anxiety beneath the surface. And perhaps most tellingly, the Smart Money Flow Index, which tracks institutional positioning, has been diverging from major indices since August. What these indicators collectively suggest is that sophisticated market participants are positioning for turbulence ahead. They're moving into gold as a safe haven, while simultaneously expressing caution about global economic growth prospects through their oil positioning. Let me share something that few analysts are talking about. The last time we saw this specific combination of signals, an extreme gold-to-oil ratio, persistent yield curve inversion, and smart money divergence, was in late 2007, just months before the global financial crisis fully manifested. I'm not suggesting we're heading for a repeat of 2008. Every market cycle is different, but the historical rhyming is impossible to ignore for those who understand these patterns. So what does this mean for your investment strategy? First, recognize that extreme readings like this rarely persist for long. Markets eventually revert to their long-term averages through some combination of price adjustments. If history is our guide, energy stocks may represent a compelling value opportunity right now. Companies with strong balance sheets, low production costs, and healthy dividends could be positioned for significant upside if the historical pattern repeats. Conversely, pure gold plays might be approaching a period of consolidation or correction. That doesn't mean abandoning precious metals exposure entirely, just being selective and perhaps taking some profits if you've benefited from the recent rally. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where these markets are headed next. Beyond the direct plays on gold and oil, this ratio's warning signal has implications for your broader portfolio allocation. Historically, when this ratio begins to normalize from extreme levels, we often see increased volatility across all asset classes. Defensive sectors like utilities, consumer staples, and healthcare have typically outperformed during these transition periods. Quality companies with pricing power and low debt tend to weather the storm better than high-multiple growth stocks with questionable paths to profitability. There's another fascinating aspect to the current situation that deserves attention. The gold-to-oil ratio isn't just a technical indicator. It reflects fundamental economic forces and human psychology in action. Consider what's happening with global central banks. They've been on an unprecedented gold buying spree, with 2024 purchases already exceeding the previous year's record. The Central Bank of Russia has increased its gold reserves by 70% since 2018. China has added gold monthly for 2 straight years. Turkey, India, and Brazil have all substantially increased their holdings. These aren't random decisions. Central banks are preparing for a changing international monetary landscape. The de-dollarization trend that began as a trickle has accelerated into a steady stream, with more international trade being conducted in currencies other than the US dollar. Meanwhile, the physical oil market tells its own story. Despite relatively stable prices, we're seeing significant changes in global flows. Russia has redirected its exports eastward, while Saudi Arabia has been strengthening ties with China. The petrodollar system that has underpinned global trade for decades is evolving before our eyes. These structural shifts help explain why the gold-to-oil ratio has reached such extreme levels. It's not just about commodity prices. It's about a global recalibration of value in a changing geopolitical landscape. Now, let's talk about what typically happens when this ratio begins to normalize from extreme levels. The adjustment rarely occurs smoothly. Instead, we often see a period of heightened volatility as markets search for a new equilibrium. During the 2008-2009 period, as the gold-to-oil ratio peaked and began to decline, we witnessed some of the most volatile trading days in market history. The VIX Volatility Index hit levels not seen before or since. Daily price swings of 5% or more became commonplace. The key to navigating such environments is preparation, not prediction. No one can time market turns with precision, but understanding the historical patterns allows you to position your portfolio defensively while maintaining exposure to the eventual recovery. One strategy worth considering is a barbell approach. combining defensive positions that can weather immediate volatility with carefully selected value opportunities in sectors likely to benefit from the coming rebalancing. For the defensive portion, Treasury inflation-protected securities, high-quality dividend stocks, and select precious metals exposure can provide ballast. For the opportunity side, energy companies with strong balance sheets, low production costs, and healthy dividends may offer asymmetric upside if oil prices recover as the ratio normalizes. There's a psychological dimension to this situation that's equally important to understand. Extreme readings in indicators like the gold-to-oil ratio often coincide with periods of maximum sentiment divergence. The crowd becomes overwhelmingly positioned in one direction, creating the conditions for a powerful reversal. Right now, sentiment toward gold is extremely bullish, while oil remains unloved despite tight physical supply. This sentiment gap itself becomes fuel for the eventual mean reversion that history suggests is coming. Let me share a historical example that parallels our current situation in remarkable ways. In early 2000, the gold-to-oil ratio reached what was then an extreme reading of around 30. Gold was deeply out of favor, trading below $300 an ounce, while oil had begun to recover from its late 1990s lows. What followed was extraordinary. Over the next decade, both commodities embarked on historic bull runs, but the ratio normalized as oil initially outperformed. Those who recognized the signal and positioned accordingly participated in one of the great commodity bull markets of the modern era. Today's extreme reading of nearly 65 suggests we may be on the cusp of another significant rebalancing, potentially even more dramatic given the greater extremity of the current ratio. There's another critical factor to consider: the role of derivatives and paper markets in potentially exacerbating these imbalances. The physical gold market has become increasingly disconnected from the paper trading that dominates price discovery. Recent analysis from the London Bullion Market Association shows that for every ounce of physical gold changing hands, over 100 ounces trade in paper form. This leverage creates the conditions for sharp price movements when sentiment shifts and participants rush to convert paper claims to physical metal. Similarly, the oil futures market has seen increased participation from financial players with no intention of taking delivery, potentially distorting the price discovery process away from physical market fundamentals. These structural market changes help explain why the gold-to-oil ratio has reached such unprecedented extremes. The financialization of commodity markets has allowed prices to diverge from physical reality for extended periods, but not indefinitely. History teaches us that physical markets eventually assert themselves. When they do, the correction can be swift and powerful, catching consensus positioning off guard. So what specific actions should you consider in light of this warning signal? First, review your portfolio's exposure to both gold and energy. If you've benefited from the gold rally, consider taking some profits and reallocating to high-quality energy names trading at depressed valuations. Second, ensure your overall asset allocation is prepared for increased volatility. This might mean raising some cash, adding defensive positions, or implementing hedging strategies if appropriate for your situation. Third, watch for signs that the ratio is beginning to normalize. The initial stages of this process often provide the most attractive entry points for positioning ahead of the full rebalancing. Remember that markets rarely move in straight lines. The path to normalization will likely include false starts, whipsaws, and periods of confusion. Patience and discipline become essential virtues during such transitions. What makes the current situation particularly noteworthy is the confluence of signals across multiple timeframes and indicators. It's not just the gold-to-oil ratio flashing a warning. It's the alignment with other key metrics that have historically preceded major market turning points. The Smart Money Flow Index, which tracks institutional positioning, has been diverging from major indices since August. The put-call ratio has been making higher lows despite market strength, suggesting growing demand for portfolio protection. And perhaps most tellingly, credit spreads have begun to widen after a prolonged period of compression. These signals, taken together, paint a picture of sophisticated market participants quietly positioning for turbulence, while retail sentiment remains relatively complacent. This divergence itself often marks the final stages before a significant market repricing. I want to emphasize that this isn't about fear-mongering or predicting doom. It's about recognizing historical patterns that have consistently provided valuable information about future market direction. The gold-to-oil ratio is simply one of the clearest such patterns available to us. Throughout market history, Paying attention to these relationship-based indicators has provided an edge to those willing to look beyond headlines and narrative. While the financial media focuses on daily noise, these deeper structural signals often reveal the underlying currents that eventually become impossible to ignore. The coming months promise to be fascinating as markets navigate these crosscurrents. The gold-to-oil ratio's warning signal doesn't tell us exactly when the rebalancing will begin or precisely how it will unfold. But history strongly suggests that the current extreme is unlikely to persist indefinitely. Those who understand these patterns and position accordingly may find themselves not just surviving the coming transition, but potentially thriving through it. After all, market dislocations create opportunities for those prepared to capitalize on them. The gold-to-oil ratio is flashing a warning that deserves your attention. History tells us what typically happens next. The question is, will you be prepared when it does?